When designing or reviewing your portfolio, two of the most important considerations are risk tolerance and time horizon. As we know, some investments are riskier than others. And for someone who would lose sleep if their portfolio dropped by 10% over the course of a year, they would be ill-suited to a 100% stock portfolio, as that will happen from time to time. They may be better suited to a portfolio that has more fixed income. Other investors who are willing to take on a high degree of risk in exchange for the potential of higher long-term returns may find the short-term losses to be an acceptable trade-off for their long-term investing goals. There are two aspects of risk you should consider: your financial ability to handle loss and your willingness to accept fluctuations in your portfolio's value. These are quite different. Your financial ability to handle loss is what would happen to your overall financial situation if you experienced a large loss with your investment portfolio. If you lost the money you invested, or a significant portion of it, would you have to make a change to your lifestyle? Would it strain your ability to pay your bills and fund your lifestyle goals? Your willingness to tolerate fluctuations in the value of your investments is more about understanding your emotional reaction to seeing volatility in the value of your portfolio. Of course, many investors want to focus on the return potential, but higher potential returns come at the expense of more risk. One big mistake an investor can make is abandoning an investment or investment strategy when they see losses on their statements. Let's look at two different hypothetical portfolios. One is very aggressive with an asset allocation of 90% equities and 10% fixed income. The second portfolio is balanced and has a 60% equity, 40% fixed income split. Here are their hypothetical returns for a 1-year period. We see that the riskier portfolio suffered a very large decline halfway through the year, a drop of 20%, and ended up with a negative return for the year. $50,000 invested at the beginning of the year turned into $45,000 by the end of the year. That's a 10% loss. Our balanced portfolio had a much smaller decline halfway through the year. Its drop in value was only 8%, and it ended up with a small positive return by the end of the year of 1%, for an ending value of $50,500. Now, if we simulate another 4 years, we see that the more aggressive portfolio ended up with a higher value in the end, but the ride was much more volatile along the way. Now let's add in another 15 years for a total of 20 years of hypothetical returns. What we see is that over the long term, our focus is pulled towards the end result. The more aggressive portfolio left us with a much higher ending portfolio value. But when looking at long-term market performance, we have to remember that we live through the short-term fluctuations that really test investors. In our minds, we might think we could deal with losses of a certain magnitude, but it feels different when we actually have money invested and see those losses play out. If the stress of losses causes an investor to abandon their investment or investment strategy, those losses will be locked in. And if we were to sell and then we see those investments regain value while we were not invested, we then feel the regret of having missed out on those gains. We might then invest back into these or similar investments only after those gains have been made, which means we will have missed out on those gains. Some people have a higher tolerance for risk and some people have a lower tolerance for risk, and that's okay. You just have to remember that when choosing the appropriate risk level in your portfolio that is right for you. It's often been said that the best portfolio for an investor is one they can stick to. Another thing you might have noticed from looking at our long-term chart is that if we had a shorter time horizon, the more aggressive portfolio may have had losses over some 5-year periods and even had a 10-year period where there would have been a loss. But if we look at our balanced portfolio, the worst 5-year period still had a positive return, and the worst 10-year period had a better return than the worst 10-year period for the more aggressive portfolio. Time is a critical component when it comes to the risk exposure you may want in your portfolio. While you may have a high tolerance for risk, if you are only going to invest for 5 years, you may want to restrict your portfolio to a lower level of risk. Conversely, if you have a long time horizon, let's say you have 30 years to invest because this portfolio is for retirement, but your tolerance for risk is low, then you would be better off in a more conservative portfolio because you are more likely to stick with it for the long haul and sleep better at night.